Dear all, welcome back. We continue with the last session of today's program on the optimality and the realities of the current financial crisis management framework in light of recent stress events. Before the discussion starts, it is my pleasure to welcome on the stage Mr. Dominique Laboureix, Chair of the Single Resolution Board, to deliver his keynote presentation on this topic, and afterwards to take a seat on the stage. Please give him a warm welcome.
Good afternoon, ladies and gentlemen. First, I would like to apologize for arriving so late. I had some difficulties to find the central bank. Can you imagine that? It's not so difficult to find the central bank, but well, at the end I had some difficulties. So I would like to thank you for organizing this conference and inviting me. And before the panel, you've mentioned it a minute ago, I would like perhaps to come back to some lessons we could draw from the events which occurred exactly 1 year ago, and also the elements that we hope will go to complement our framework. So I would like essentially to develop these two topics. So let me start perhaps by the lessons learned, as we call them. So last year, we witnessed the failure of 3 American regional banks, so-called regional banks, whose combined assets amounted to almost $550 billion. So, regional has not the same definition in the US and in our old European countries, obviously. But still, if you compare to the GDP, they are definitely small banks. At the same time, we saw in Switzerland the demise of a GSIB, which was at the end acquired by another GSIB via a so-called private transaction supported by the public bodies. The authorities stabilized the situation both in the US and Switzerland. They protected financial stability, but using unprecedented measures, implying also support coming from public bodies and public purse. These events have prompted a range of questions about the adequacy of the prudential frameworks and the credibility of the resolution regimes. Both the Basel Committee and the Financial Stability Board published in October 2023 reports presenting the preliminary lessons from these failures. I would like to focus on the lessons learned, but from a crisis management standpoint. I will let aside the supervisory elements. In terms of crisis management, the review of the FSB concluded that, yes, the system worked, but it also identified several implementation issues. Among the positive aspects, resolution planning and capabilities, coupled with enough loss absorbency capacity, provided a credible plan B to the UBS transaction. So that, what I mean by plan B is that the plan A at the end was to sell the bank to another one under, again, a private transaction. But in reality, this sale was possible because the authorities were ready to implement the so-called Plan B, that's to say a real resolution regime. And for that, they built different steps, and that's why they were, in reality, able to help this transaction. In addition, another positive element which should be underlined is that Credit Suisse was treated as one single entity. No ring fencing along national borders was ever on the table. A major improvement with respect to the past that was brought on by the framework and by the cross-border work of all authorities involved. Remember the 2008 crisis with all these ring-fencing measures. So these feats only 10 years ago would have been unthinkable. Finally, cross-border cooperations and crisis communications within the crisis management groups worked well. It allowed for thorough contingency planning in the build-up of the crisis. This leads me to the implementation issues. For brevity, I underline only 4 of them. The first one is that we resolution authorities, definitely need optionality for resolution strategy and tools, depending on the scenario of a crisis. Because indeed, we cannot know in advance the type of crisis we will be confronted with. It can be a traditional solvency crisis. It can be, as we've seen, a reputation crisis based on liquidity runs. It can be sanction crisis like Sberbank in 2022. It can be made of different types. And if we prepare only for one tool with one set of elements to be implemented based on one type of scenario, we won't be able to succeed, definitely not. So other strategies, transfer tools, combination of tools could be more appropriate in certain situations, depending again on the type of crisis. This, however, does not make bail-in less of a priority. Today, at the single resolution mechanism level for the significant institutions, 80% of the banks have a preferred resolution strategy based on an open bank bail-in. So I don't want to make you thinking that we are moving completely from a full bail-in approach to something completely different. Obviously, bail-in will still be a priority. Basically, nevertheless, we need to remain nimble with backup options in our resolution strategies. We should be able to switch or to combine tools to respond effectively to each situation. In Europe, the Single Resolution Board is working intensively on the operationalization of resolution tools and procedures according to different scenarios. This is also done through dry runs involving national authorities and other EU authorities. The second lesson I would like to draw your attention upon is the one referring to the need to work further on this famous operationalization, this time of the bail-in tool in a cross-border context. Because what we've seen is that a part of the absorbing instruments are held by non-domestic investors. In such a case, compliance with applicable securities laws, such as the US one, as an example, in the case of Credit Suisse, requires detailed preparation, including potential disclosure of pro forma financial statements to the market in the event of a resolution. It's crucial that the main countries facilitate the recognition of resolution actions exercised by foreign authorities in other jurisdictions. If, for a cross-border bank, there is not this common understanding of the implementation of the tools, we cannot succeed, definitely not. The third lesson I would like to mention is the importance of liquidity in a crisis. No need to insist too much on that one. I think this one is obvious. Unsurprisingly, liquidity proved once more to be vital to restore financial stability and individual stability in banks. With financial stability in mind, both the Swiss and the American authorities moved swiftly and decisively to provide liquidity to the failing banks or to the ones buying the others. We are intensively working with our banks to be sure that they are able to mobilize all available collateral in times of need. The fourth lesson I would like to mention is that we need to ensure that information sharing, international cooperation for internationally systemic banks is further enhanced, including in cases where a resolution authority is not a member of the so-called crisis management group, or where the crisis management group is not activated or even not existing. The failure of a systemic bank could cause instability even in places where the bank does not operate directly. Another element I would like to draw is the communication, and this goes beyond the four lessons I mentioned. It's a broad element which is true not only at the moment of a crisis, but even more before the crisis. The more we communicate together, the better. In the European Union, we know one thing or two about communication. Because indeed, if we are not able to communicate in such a complex setup with all the member states, authorities, etc., we won't be able to succeed. So this is in particular important in times of crisis, but as I said, not only. Within the banking union, so here we are in a European country and not member of the banking union. A banking union is made today of the 20 members of the euro area plus Bulgaria, so 21 countries out of 27. So within this banking union, we are coordinating between the various authorities to build together the single resolution mechanism at all levels. That means that most of our daily work is done in close cooperation with national resolution authorities, members of the banking union. Of course, the communication and coordination work does not stop there. For a number of the institutions within our remit, we also work with EU countries outside the banking union, like here, like Hungary, both in resolution planning, that's to say during the peaceful times, or in crises during the war times. We strive to have, as much as possible, an open, direct, and timely communication with our partners. Banks operate across borders, and a resolution is truly successful if and only if it preserves financial stability everywhere. For this to happen, all authorities need to work as one. Our work should be a seamless continuum spanning from supervision to resolution, from national to supranational authorities. This is how we establish trust in our system. This is why, for me, it's so important to visit European countries that are not part of the banking union. Our relationship with the local authorities is of the utmost importance to me. Let me go to my second big part about the improvements to the European system. As I told you, what we think as a resolution authority is that the framework, last year in particular, worked at the end fairly well. But is this enough? That's the question. Let me start about trust. Speaking about trust, authorities can only operate within the boundaries of their framework. The fact that European banks were barely touched by the recent turmoil is, as I said it, a success of the current framework. Our framework is strong, made of strong supervision, strong regulation, strong resolution framework, well implemented with strong management at bank level, strong risk management at bank level. This said, we should not be complacent and nurture our success by keeping our crisis management framework up to date. This is a key message to deliver in the country that will soon take the rotating presidency of the Council. The Crisis Management and Deposit Insurance Proposal, the so-called CMDI for short, would indeed enrich our framework. CMDI increases the options and tools available to supervisory and resolution authorities for the management of a banking crisis and provides a pragmatic and efficient solution for the problem of mid-sized banks with a regional systemic footprint. Indeed, CMDI introduces an alternative way of funding a market exit of a bank in crisis if it is in the public interest. Resolution authorities could tap deposit guarantee schemes and possibly even the single resolution fund for those banks within the banking union in lieu of depositors to facilitate the sale of the ailing banks. By doing so, we would defend depositors without using taxpayers' money. Losses from the banking industry would be confined to the banking industry. The estimations published by the SRB show that the impact on industry funds would be limited because MREL would be the first line of defense for the banks earmarked for resolution, and because of the relatively small size of the banks in question. We're happy to see that the Econ Committee in Parliament last week has found a compromise on this text. We are still analysing the impact of the final compromised amendments, but I can already say that having a deal is an encouraging step forward. As you know, for building such an agreement. There are still other steps to take, including a vote in the plenary session of the European Parliament, and then it will go to the Council in parallel. The Belgian presidency is working hard to try to finalize an agreement on the Council side. And if it's not the case, it will be for the Hungarian presidency to try to find this agreement during the next semester. Also, in this text, coming back to the proposal made by the Commission, there are other elements to work on, and in particular on the liquidity side. So beyond a CMDI, I think we should not stop thinking about improving the framework we have. Even if banks are very well prepared, we cannot rule out that their liquidity will not be enough in time of crisis, as we have seen it recently last year. In times of need, our Single Resolution Fund stands ready to provide for liquidity. The Single Resolution Fund has now reached nearly 80 billion euros, and its firepower will almost double if the revised ESM treaty is ratified. I still hope that there will be the final signature that by one of the 21 countries I've mentioned, which is still missing. So let's hope that we can find an agreement here. Yet, the liquidity needs of a global systemic international bank may go even beyond the SRF means. We stand ready to find a solution for these extreme tail risk cases. In this vein, given how critical liquidity is in a crisis, the Single Resolution Board is also contributing to the FSB working group on the design features of public liquidity backstop mechanisms. Finally, and this is a third dimension, I ideally hope that in the next legislative cycle, perhaps already starting under the next presidency, the process of completion of the banking union is taken up again, even in the form of liquidity-only EDIS to start with. This hybrid model could be followed at a later stage by the introduction of loss-sharing provisions. This reform would encourage more cross-border banking and further strengthen competitiveness and resilience of the banking sector within the banking union. Without the safety nets, it's very hard to remove the hurdles that stand in the way of the integration of our banking market. And that's why I would like to conclude now by saying that, again, even if we consider that we've been able to withstand the last wave of shocks, we should not consider that we are at the end of our journey for a fully fledged resolution regime. For several reasons. The first one is that risks themselves are evolving, and we need to be ready to tackle these new risks, which were completely unexpected at the moment of building the regulation about resolution. Who could have thought about a pandemic like COVID? Who could have thought about the consequences of a war in Europe? Who could have thought about the energy crisis, the guilt crisis, etc., etc.? All these type of crises, they're very far from the, let's say, the last features of the great financial crisis of 2008. So the risks are evolving, but on the other side, we are also evolving, and we try to catch these new risks in a proper way. So that's why I ideally hope that, and I come back to my first lesson coming from the events of last year, that we can find a good level of flexibility, optionality in the regimes to be built in the future, because we need to be able to give confidence in our powers to ensure this famous financial stability, which is so crucial for keeping the confidence our citizens need in their banking sector throughout Europe. Needless to say, a safer banking union means a safer European Union, a safer banking systems in Hungary is also part of a safer European Union. We are all in the same boat. Let's not forget it. Thank you very much.
Thank you, Mr. Laboureix, for your presentation. Now it is my pleasure to ask Mrs. Krisztina Láhm Földényi, the director of the Resolution Directorate of the Magyar Nemzeti Bank, to moderate this panel. The members of this panel are Mr. Dominique Laboureix, Chair of the Single Resolution Board, Ms. Ruth Walters, Senior Advisor at the Financial Stability Institute, Bank for International Settlements, and Mr. Thorsten Beck, Professor of Financial Stability and Director of the Florence School of Banking and Finance. Ladies and gentlemen, please join us on the stage.
Good afternoon, each of you, and thank you for taking your time to be with us in the last panel of today, which is about the current financial crisis management framework, especially in the light of the recent stress events. And I'm happy to have our panelists joining us here in Budapest and so accepting our invitation to this panel. It's a very good timing that the topic of the last panel, so at the end of such a long conference, is the crisis management. As the crisis management framework often serves as the final line of defense. So after other measures already failed, for example, the recovery plans failed, or even the supervisory measures failed, then in the end, so as the last solution is the resolution or even the deposit insurance scheme. This month, the March is also an important milestone as well. It is the one-year anniversary of the onset of the US banking crisis, which started last year in March with the failure of the Silicon Valley Bank. And what began 12 months ago actually is a reminder that how important is a robust financial crisis management framework. And it is critically important because it helps to maintain the resilience of the banking sector and also maintaining the financial stability. And thank you, Dominique, for your keynote speech. And your speech, we heard the evolution of the framework, the resolution framework in the European Union. And thank you for sharing us with the new vision of your resolution, also the SRB, the switch towards the transfer strategies. We are living in volatile times, as Thorsten mentioned this morning in his presentation, but fortunately we are better prepared now than we were 10 years ago. But in volatile times, we have to be more flexible, and we have to adapt the strategies to the different circumstances. And as a representative of a national resolution authority, I fully agree that the testing and dry runs are very, very important. So one says that the proof of the pudding is in the eating. So we have to taste the pudding and test the resolution plans, because we have to need to know whether there is any need for more seasoning or there are any gaps we have to fulfill in the resolution plans. So I prepared with a presentation, but due to the shortness of time, I would only highlight only a few things. In the evolution of the resolution framework, there are 2 years, the 2017 and 18. It was important years because in these years the emerald targets were set up and bail-in was selected as a preferred resolution strategy in most of the resolution plans, especially in the resolution plans of large banking groups. And the bail-in actually reflects the burden sharing principle of the resolution framework, so not to minimize the exposures to the taxpayers. And by the end of last year, the banks have significantly improved their loss absorbing capacity. The MREL targets are met, the fully fledged target in Hungary and also in the banking union. As we are hosting the conference, so let me just say some words about the Hungarian banking sector in the light of the resolution framework. In Hungary, the Central Bank of Hungary is the appointed resolution authority. We have 41 institutions, financial institutions under our remit, and we have resolution strategy for 16 institutions. The Hungarian banking sector has become more concentrated due to the mergers and acquisitions in the recent years. So therefore, the number of small and medium-sized banks has decreased significantly. There are now 10 cross-border banking groups operating in Hungary, and the resolution planning and crisis management works is carried out in resolution colleges, cooperating with other authorities regarding these groups. We are working closely together with the SRB, the Single Resolution Board, and with Dominique's team. As from the 10 international groups, we are working together in 8 resolution colleges. The Central Bank of Hungary is the home resolution authority in one case. It is the OTP, the largest Hungarian bank, and in other cases we are host authorities, so in host role in 7 SRB colleges. We follow a consistent approach in home and host roles, and we strictly follow the SRB practices to ensure the level playing field for the banks, and which is also interesting that we make on-site inspections since 2017, and it means that the resolvability of the Hungarian banks, so not only the MREL target are met, but also we check the data quality, data supply, and whether all the contracts that the banks have the resolution proof or not, and there is a significant improvement regarding these two things as well. And one more thing, the target level of the Hungarian Resolution Fund has to be reached until 2028. Now we have 0.8% coverage. And as you mentioned, we did a lot of things, but there are also a lot of things we had to do. You can see it on the next slide, but okay, you can read it. So let's turn to the questions. So my first question is that we have a harmonized resolution framework for almost 10 years, and banks made efforts to build up their resilience, their recapitalization. So how do you see how the banking sector is functioning in 2024 in Europe, and what do you think, what are the strengths which can contribute to their resilience? So I would like maybe Ruth or Thorsten. Okay.
Thank you. I think there's a general agreement that we went into the crisis last year, the banking turmoil last year, in a much stronger position than we would have 10, 15 years ago. The Basel reforms following the financial crisis resulted in a hugely improved quality and quantity of capital, though there are questions about the going concern loss absorbency of AT1, and I think that's something that's going to play out over the next couple of years as to the fate of AT1. Resolution frameworks generally have increased the reduced contagion risks, reduced the impact of failure, and increased the financial sector resilience as a result. We have on balance sheet loss absorbing capacity, additional loss absorbing capacity capacity for managing failure. In addition to that, we have mutualised external funds in a number of countries, resolution funding, deposit insurance, depending on the national framework, which are all available. So we're in a fairly good position, and we had an opportunity to test that, as everybody's been saying, last year. Banks which were on paper very different but shared certain similarities, all of them failed at a point where they were still meeting their minimum capital requirements, but they were all characterised by flawed business models. In the case of the American regional banks, unsustainable exposures to interest rate risks, leading to a sharp increase in unrealised losses, coupled with unusually high volumes of uninsured deposits, and from a concentrated and highly networked set of sophisticated, tech-savvy investors, which afterwards, hindsight is great, proved to be a structural weakness in those banks, but that hadn't been dealt with in advance. Credit Suisse, well, that was more obviously flawed. That had been seen. There'd been long-standing market concerns about the business model and the risk management in Credit Suisse, which hadn't been addressed to the satisfaction of the markets over a sustained period. It had suffered extreme liquidity stress in the autumn of 2022. Its LCR had been sufficient to withstand that, but it never really bounced back. And in the event of the March turmoil, coupled with the failure to publish annual reports on time and the statements from the significant investor, then the market sort of fled from it. And then against that, as has also been said, we had the rumours fanned by social media. We had the digitally enabled, accelerated deposit withdrawals. A bit of a perfect storm. What can we conclude from this about banking sector resilience? Well, as Dominique and others have said, we survived. The actions taken stabilised the situation. There wasn't significant contagion. But in each case, it required extraordinary action from the authorities. Neither the Swiss nor the American authorities did it by the book. The American authorities at least used something which was a statutory provision. So they made a systemic risk determination. It's there, it's available in statute, but an anticipated use of it. It had only been used on a handful of occasions before in relation to much more obviously systemic banks. These were not the kind of banks you would expect a systemic risk determination to be made for. And these were banks that hadn't been regarded as systemic for supervisory purposes previously. So a slightly unorthodox use of statutory provisions. In the case of Switzerland, well, they didn't go with the preferred resolution strategy. They didn't use their statutory resolution powers, but opted instead for a state-sponsored commercial transaction relying on the adoption of certain emergency powers, the adoption of a quickly cobbled together ELA plus liquidity framework, some of which was uncollateralized. They'd been working on a liquidity framework, but it hadn't yet been put in place, so they had to do it on a bit of a shoestring. And federal government guarantees, which have now been terminated, so no actual cost to the Swiss taxpayers. But speaking as a Swiss taxpayer, I was exposed for a time, so there was always a risk of it. So what can we draw from this? First, the US banks that failed at that time and still didn't have any additional gone concern loss absorbing capacity. Since then, the US authorities have been consulting on a proposal to extend additional long-term debt requirements to banks with a balance sheet of over 100 billion, which would have caught these banks. And had they had that additional loss absorbing capacity, then arguably depositors wouldn't have withdrawn their funds, though depositors don't always act rationally. But you probably wouldn't have needed a systemic risk exception in order to protect the uninsured deposits in the way that they did. So one of the lessons is, and the EU already has it has MREL, you need that gone concern loss absorbing capacity. Liquidity facilities, Dominique has already mentioned that, but absolutely crucial. The Swiss are moving towards it. Some countries have got resolution bespoke frameworks, but this is something where a lot more work is needed. And finally, we've got questions about the stickiness of deposits. The massive outflows of deposits we saw suggest that maybe there's a structural reduction in the stickiness, particularly of uninsured deposits. And that has implications for regulators and policymakers. This is already happening, but consideration of the appropriate scope and coverage of deposit insurance. And I think here we have to remember that deposit insurance is only one piece of the picture. It's part of a financial safety net. It's not the only way, the only mechanism for protecting deposits. And there are a number of social policy considerations as to where the coverage limit for deposit insurance is pitched. It's the case for expanded coverage isn't necessarily clear-cut. There are other ways of doing it. One is to ensure that you have effective transfer tools and the ability to fund the transfer tools to protect access to deposits in another way. But this debate is ongoing. We saw a publication from the FDIC, which was at least going through the pros and cons of extending deposit insurance coverage in various ways. Also questions about the regulatory treatment of uninsured deposits, the way that they count towards liquidity coverage, the way there may be regulatory responses needed to make them a more costly form of funding, because if they turn out to be a structural weakness, then that's something that needs to be addressed through the regulatory framework. And finally, something about the digitalization, the social media, and the speed of deposit runs. This is now a reality. We're not going to turn the clock back on technological innovation, and arguably wouldn't want to. But this is an issue for deposit for resolution authorities. They need to be able to act arguably far more quickly. They need to have the preparedness and their contingency planning to be able to do that. And they need to, and Dominique's already mentioned this, more sort of careful consideration of the communications in the run-up to a crisis, and the extent to which a policy as to how they engage with social media, because if you've got rumours, misinformation in social media, how far do you counteract that? How far do you engage with it? So these are questions that have been thrown up.
Thank you. I'm not sure how much I can add to that. I mean, so I think Ruth gave a very kind of comprehensive, holistic view on what happens. Maybe just to add a few points. I mean, so why not in the euro area? Why not in the EU? And I can point just a few things. Number one, I think European banks, European supervisors have done their homework, both in the regulatory framework, Basel III, which again, for some of these banks in the US was not the case. So there's a stronger resilience. I'm going to qualify this in a moment. Number one. And number two, I think a lot of credit goes to the SSM. I mean, just to be a bit provocative and kind of extend a little bit on what I said this morning. So after the private solution for Credit Suisse with state support, that's how we call it now, no? Okay. There was a large euro area bank that came under pressure. We know it was more liquidity issue, speculative issue in the CDS market. But there was, I think there were like investors looking around, who's next from the large European banks? It didn't happen. And I think the reason is, for a large extent, SSM. So if I just go into a parallel universe and think the SSM hadn't been there had been only a national supervisor who had maybe not done the same kind of homework that the SSM has done over the last 10 years, maybe the outcome would have been different. And Credit Suisse would actually have been a trigger for more contagion across, for example, also the euro area. So I think, again, there's a lot of credit going to the SSM, having really forced the banks, the significant institutions, especially significant institutions, to do their homework over the last 10 years. And that, of course, a part of that is what Ruth already mentioned, is this whole issue with business models. Looking at business model, looking at governance structures. I think that's important. Now, and final lesson, and I'm not trying to provoke Dominique, just to make sure that I say this right away. I think there is still a weak point, and we've seen it in the US, we've seen it partly in Switzerland, but the resolution part is still a weak link, and I think there has to be much more done. Again, this is not a criticism of the SRB, not at all. I think there has been, I mean, the build-up of the SRB, both under Dominique and his predecessor, has been impressive. But I think in terms, I mean, Dominique pointed out himself, the CMDI is, of course, extending the toolkit because it turned out to be too limited. And I think there is, if it really would come to a major fragility, systemic distress, there would be a lot of, again, reliance on the SSM. I'm not sure how much reliance there can be on the current structure of the SRM. And I'm not saying SRB, SRM, the overall structure. So that's a little bit of a concern that I would have. The final point I want to make is, I'm going to leave this as a question. I mean, yes, European banks have resulted very resilient, but if you look at their long-term viability, let's say again, market book values, it's still very low, so it hasn't really caught up. So I'm still a bit concerned about that, which again might be for lots of other reasons that we can discuss.
Thank you very much for your answer. So I'd like to address my next question to Dominique and to Thorsten. So the past financial crises were mainly credit-driven, but the new landscapes, such as new external risks, which influence economic stability and or bank resilience. What do you think, what are the new elements of risks of the current times, and what the resolution-related responses could be to mitigate them? So maybe Dominique may.
Well, I cannot resist to come back first to the provocation. No, but just perhaps to one thing to be clear. You mentioned it, by the way, Krisztina. 10 years ago in Europe, there was nothing. There was nothing. No regulation, no authority. The FDIC in the US was created in 1933. That's to say 90 years ago. So 1 century ago, more or less, in the wake of the great crisis of 29. So that means that indeed we are still suffering a little bit of a lack of confidence in the resolution framework itself. Does it work? I receive this question regularly. Yes, okay, it worked here, it worked there, Banco Popular in 17, Sberbank in 22, but will it work next time? Well, I don't know, but I suppose it will work. We've built all the steps for making it working in a good way. And this permanent lack of confidence in the framework is not good in reality for financial stability, because it's all about confidence, all about trust. And if we do not convey the right message, that's to say we have given ourselves all the tools and means possible to tackle the new risks or the existing risks as far as we can, then we won't succeed, because there will be always this remaining element. Let me say, I was in charge of Banco Popular in 17 and other crisis cases. Yes, indeed, if you ask me, but were you sure to succeed? No, you're never, ever sure to succeed when you implement a crisis management decision at the end of the night. But you need to trust the resolution framework, and you need to trust your teams, the ones which worked the month before, the weeks before, the days before, in connection with the other authorities to prepare as far as we can the implementation of the decision. One thing which is extremely difficult is that a resolution is a one-shot gun. That's to say, you need to be successful immediately. If you're not successful, confidence is not reestablished, then the flows, the outflows continues, the liquidity situation deepens, and then you're obliged to come back to square one. That's to say, let's go to liquidation. So And when you say Thorsten, I can say that because I was a supervisor for so many years on the other side, I mean on the SSM side. When you said, well, look, the SSM very successful, the SRM not sure. But the reality is that when the bank fails and go to the SRM, it's because the SSM was not able to find the appropriate decisions and solutions, not because they were not good supervisors, but because there is a limit to the powers a supervisor can implement. And this is exactly the reason why we've built this extra mile. That's to say, okay, let's try to provide for something else from the administrative side and not on the court side, because liquidation is on the court side. And coming at the end, after all this long answer to your question about the risks, one thing which is absolutely striking and which will give the possibility to Thorsten to continue asking the question of the level of trust we can give to the resolution framework is that risks are evolving, and that the regulation we adopted 10 years ago was built on a very specific type of risk. That's to say, the traditional to some extent, but the traditional risks, credit risks, creating losses, hidden or not, and at the end creating a sort of lack of confidence which was translated into a bank run. This was the 2008 typology of crisis. This was, by the way, the Credit Suisse case, because it was very, very crystal clear. All the losses, all the mistakes made in the past by Credit Suisse were paid at the moment of a crisis, and with all these withdrawals and lack of confidence, saying, well, this bank this time, it's too much. So this is a traditional approach, but there are new risks coming from the structural changes. You've mentioned digitalization. We can mention also a climate change. Climate change will not create a crisis tomorrow morning, and it's not because it's hot today that the bank will fail. But there are structural features which can create the conditions of a completely unprecedented type of crisis, based on two things. First, the transition risks linked to climate. Second, reputation risk. Reputation risk. Once a bank is considered as insufficiently green or whatever, you can have reactions also on social media, creating the conditions of a run. So this is completely unexpected, and a bank can die while being extremely solvent, but not able to repay what falls due. This is exactly the liquidity crisis case. And that's true that from that side, the equipment, the toolkit we've received is meager compared to the one on the solvency side. On top of that, there are completely new risks, which are not well yet understood, coming from I've mentioned digitalization. Let me come back to this one. Cyber risk. If there's a cyber attack, blocking a bank, what does it mean in terms of resolution? Are we able to tackle such a crisis with the tools we have? We can implement a bail-in decision, but for implementing a bail-in decision, we need to know the data. We need to know the bondholders, shareholders, etc. If the system is corrupted, how can I implement a bail-in? So this is the type of questions we are trying to tackle now, based on completely unprecedented elements. And the best thing to do, you mentioned it already, is to consider that we've achieved already a number of key steps in building resolvability via loss-absorbing capacity, via all the elements about the IT systems we ask banks to prepare for. But the best thing to do is to test and to create the conditions of these tests with banks, asking them to provide valuation at once, to provide data for implementing a bail-in decision at once, and seeing if they would be able to withstand certain types of shocks. And if not, it's for us, and when I say us, I mean the resolution authorities, but also the banks themselves to find the solutions to be able to withstand the new shocks which are coming to us in the coming years. Obviously, they will come to us, and we want to be ready, definitely.
Yes, thanks. I cannot avoid to follow up on Dominique. Actually, I want to reinforce what he said with a personal anecdote. So until July 2008, I actually worked in the World Bank, and I did a lot of work in the so-called FSAPs. Anke Weber this morning mentioned these, the financial sector assessment programs, looking at financial safety nets in emerging markets, among others, Bolivia, Brazil, Kenya. And so I've kind of also used to the idea of having bank resolution frameworks. And when I then came to the Netherlands in September 2008, just in time for the problems in ABN AMRO and ING. So I asked my colleagues, well, how do you resolve banks in the Netherlands? And I got these really weird looks, kind of like, where does this guy come from? We don't do a resolution here, no? And so that's, so I think, again, as you said, Dominique, I think we have come an enormous long way, I mean, over the last 16 years. I mean, the glass is really half full, not half empty. So that's what I just want to say. And just, of course, you can even take a longer view and say, well, the US took 200 years to get to a banking union and 13 systemic banking crises in between. Let's hope it's not here the case, but we have a long way to go. So yeah, it's, now, on the kind of the risks. So kind of following up on what Dominique has said. So I guess the main risks are really concerning, again, solvency, viability, because I see liquidity more as the kind of the canary in the coal mine. And again, if you have a cyber attack, I mean, if you have a good backup plan in place and can kind of get out of the problem quickly, it might not have to affect the solvency. It can, of course, affect the reputation, which is a more the viability issue. So I think that's, or similarly what Dominique mentioned in terms of being a green bank, or being exposed to certain sectors that are, again, subject to transition risk or to the physical risk. Maybe just one additional risk category, if I may. Well, so two more, actually. One is the geopolitics, of course, subsidiaries in countries where there is, how was this mentioned this morning? There's the geopolitical distance increases. I think that's how we call it, right? That's one, and of course the other one is also from the non-bank side. Are there risks being brought back from the non-bank arm, subsidiaries, or even arm's length counterparties of a bank on the bank's balance sheet? And again, we've seen something which wasn't even non-bank, it was just non-financial in the case of Banco Espírito Santo in Portugal in 2014, I think. So I think these are risks, and I think that in the case of non-bank finance, they might actually even increase over time, maybe again also related to digitalization and to the rise of fintech companies.
Perhaps one word on what you said about the number of crises the US faced before reaching this good expertise. That's true, but at the same time, look, as you said, Ruth, they were obliged to take unprecedented measures despite the 90 years. They covered all the deposits without any limit, everybody, which is completely unorthodox compared to the famous theory of moral hazard, etc. At the end, the federal state covered all the depositors based on the mistakes made by these banks. At the end, the central bank, the Fed, was obliged to open a dedicated new liquidity line at par value. We are in a central bank here. Can you imagine what it means for a central banker to take assets at par value, zero haircut, zero? This is completely unprecedented. To say that digitalization, new type of risk, social media impact, etc., can create the conditions of things which were not anticipated. And I think it's a good lesson for us also to be able to tackle. A last word on NBFI. I think we are going to a point where, in Europe in particular, we've started to tackle the non-banking financial institutions. So we've tackled the banks, key attributes at the FSB level, etc., then key attributes for insurers, then key attributes for CCPs, and then the translation in the European context with a directive just adopted for insurance and a CCP one adopted a longer time ago for CCP resolution. But what are we doing for the investment funds? What are we doing for these enormous systemic institutions? Absolutely nothing. The FSB is discussing liquidity, good, transparency, good, macroprudential elements, excellent, but what about crisis management? For the moment, there is absolutely nothing. And due to the interconnections between these players, we need to identify the players, obviously, among the so-called non-banking financial institutions. But some players are definitely systemic, and to stop at the border of the regulated system saying, yeah, but if there's a problem due to the good management of crises by the other authorities with the regulated entities, we will protect it against the others, it's not true. This is not what I think.
We have only 10 minutes left, so actually, no. So, next question relates to the CMDI proposal. So, how do you see the impact of the CMDI package on the present crisis management toolbox and the deposit guarantee scheme? So, first, I'd like to ask Ruth and maybe Dominique, if you would like to add something, you can. So, thank you.
I mean, I won't say a great deal about the CMDI proposals because Dominique has already covered it in his introductory remarks, and I think he's probably better placed than I am to have an informed view of it. But in brief, I think they're sensible, they're pragmatic proposals, they're aimed at addressing the issue that everyone's identified with small and medium-sized banks that may well need to be resolved, may well need MREL above the minimum capital requirements, but are not banks which are necessarily able to issue MREL in huge quantities, or will be relying mainly on equity. And as we all know, there's a very real risk that equity will not be there when you come to need it. So I think the proposals in the CMDA about the elimination of the super preference, replacing it with general preference. I don't know if that survived, but it really should survive. And the ability to use the deposit insurance contribution as a bridge to the use of the resolution fund are useful, pragmatic proposals which should go some way towards addressing this problem of medium-sized banks. You asked also, sort of in our preliminary discussions about deposit insurance and its role in the financial safety net. And I think the trend generally internationally with deposit insurance is away from pay box only towards the idea that deposit insurance is probably most effective in protecting depositors when it's able to help fund the continuity of access deposits through a transfer. We're seeing this generally. If you look at the IRD statistics, there's a move towards as a minimum pay box plus away from pay box only. So this is the trajectory of deposit insurance, that it's being seen as it's integral to resolution. The concept of deposit insurance really predated resolution in its modern form internationally, and it's now kind of catching up and integrating into resolution frameworks, and I think that's the way it's going. And I'll say one thing which was an interesting proposal coming out of the UK. At the moment, it's not even a green paper, it's just a sort of a consultation, but it's in response to the events around SVB UK, which last March failed because its parent was failing. It had been a bank that had been earmarked for winding up, for insolvency, but a bit like its US parent, it had a concentration of depositors, the tech sector. The UK government was worried about the idea of pulling the plug on it, putting it in insolvency. So the Bank of England was, over the resolution weekend, running two strategies in parallel. both preparing for liquidation, but also exploring a transfer, and in the end managed to pull off a transfer. It didn't need public funds to do this. It did it through a write-down of equity, its AT1 and its Tier 2, and it was sold to HSBC for £1. So it was a successful resolution to that extent. But in response to this, there's a recognition that circumstances change. You don't know what the circumstances of a failure are going to be. You may have had a bank that was earmarked for liquidation, which in the UK and in the EU means it's not going to have MREL. So if you do then need to resolve it, you're going to have a funding issue. Deposit insurance may help there, but its contribution may still be limited. And what the UK are proposing, which is a novel tool, and is maybe possibly the only Brexit benefit I've been able to identify so far, but it's a proposal for a new resolution tool which basically allows funding from the banking sector channeled through the Financial Services Compensation Scheme, which is the UK DGS, can be used to meet the costs of a transfer. So the costs of recapitalising the bank prior to a transfer, so that to reduce the cost of the transfer, the costs of a bridge, the cost to the Bank of England of administering a bridge bank, and then the costs of the resolution authorities in relation to the resolution, so the legal costs, the valuation. And these funds will be would be recovered from the financial sector through the DGS, and it wouldn't be capped. So it's not capped to the net value of deposits in the way that a deposit insurance fund contribution is under the resolution framework, and it's not subject to the minimum write-down of 8%, which is needed for access to the resolution fund. So this is another way that a country is looking at bringing funds in for resolving smaller banks that hadn't been prepared and didn't have the loss absorbency for resolution. So I thought I'd mention that just as a way of creative thinking about these issues.
So, well, CMDI, you know, I would need 10 has, and let me start perhaps by, again, the beginning. Why such a proposal? Because it was considered that there was an interest in finding a solution for these so-called regional systemic banks. By the way, SVB, we discovered that it was a systemic bank creating the conditions of a systemic crisis while being very, very small compared to the US market. But in California, on this business model, startuppers, etc., it was a big player. So the CMDI tackles this by saying, well, if we want to have more banks earmarked for resolution, we need to identify them and to prepare them. One thing I know from my 10 years of resolution is that if a bank is not ready for its own failure, we won't be able to step in. In that case, why? Because indeed, MREL, loss absorbing capacity, will not be in place, the data availability will not be ready, the quality of the IT system, valuation system won't be enough, etc., etc., etc. So when we are confronted to a bank which is absolutely not ready, the only thing to say is to say, well, thank you, but we cannot bring a higher value in resolution compared to liquidation. So let's go to liquidation. Because in Europe, there is absolutely nothing between resolution and liquidation. The solution of 2008, that's to say, public money, the Dutch solutions for ABN AMRO, ING, etc., that's finished. Forget it. So the difference between a liquidation and a resolution is very, very simple. In resolution, you can continue to access your branch next door and to withdraw your money at the ATM. In liquidation, that's finished. The doors are closed, you wait 7 days, and you're repaid for the amount of covered deposits, and thank you. And the rest, you have to wait for the end of the liquidation. So in terms of social footprint in a society, there is an enormous difference if there is a successful resolution. And so the aim of CMDI is about that. Why not adding a small amount of banks to the long list we have already? Between significant institution and less significant institution within the banking union, we have already 170 groups covering more or less 80% of our banking system. So we are speaking about a potential addition, also outside of the banking union, obviously, yeah. If in Hungary, while you have a fairly concentrated market, I've read that coming here, if you need to consider that still there's one bank which would be regionally systemic, you could add it, and you would add this bank to become ready for its own failure by asking it to raise loss absorbing capacity, etc. All the rest is coming from this first assumption. Let's build a longer list. Then, indeed, as we are not sure, in particular in the transition phase, to find sufficient money for financing the cost of the failure, then indeed super preference, etc., 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 2-tier, 3-tier, least cost test. It's too technical for today, but there is a lot of consistency in the proposal made by the Commission. I understand that the Council on the one hand and the Parliament on the other were not pleased, because in reality, if you started to withdraw one piece of the jigsaw was completely falling apart. So they said, sorry, but we cannot just adopt a text like this. We need to enter into the details. And this is what we are doing. As I said, a new compromise, much more complex than the initial proposal, is arriving on the Parliament side. On the Council side, we are not yet there. My hope is that at the end we can achieve a better solution for us, for citizens, for customers of banking systems, by ensuring that, yes, indeed, these regional mid-sized banks, if they fail, there will be a better solution than liquidation. This is about that.
Thank you very much. So actually, we are on schedule, so I still have one question, but unfortunately, we do not have time for it. But tomorrow, I will ask Dominique, so when we meet, it's about the cross-border resolution strategies, whether do you think that the switch towards the transfer strategies will make it easier, so we'll make it more effective, a cross-border resolution. But tomorrow we can discuss it. Now, as the conclusion, so I would like all of you as to summarize what do you consider as a key message to the audience we can take away for today, one or two sentences, so maybe starting with anyone? Yes? No? Nothing?
No, but my key message, let me start. My key message: trust the resolution framework and trust the authorities in charge of implementing this framework. Yes, it's complex. Yes, it's, I'm used to be said, it's untested. Well, it's not a test. When you implement a real decision, it's not anymore a test. It's a real decision. But please consider that we've managed to address very, very specific cases, Banco Popular at a moment where we were not equipped, to be clear, or more recently, based on sanctions taken by the European authorities, the Sberbank case, a smaller case, but nevertheless extremely complex, with subsidiaries everywhere in Europe, inside banking union, in European Union, or even outside of the European Union. So a fairly complex case, and we did it. So trust the resolution mechanisms and trust the authorities. We will make it.
So then let me add, so my last word is a resolution authority. So the words of Eisenhower, who said that plans are worthless, but planning is everything. So in other words, no battle was ever won according to plan, but no battle was ever won without one. So we have to continue our planning work, so we cannot lay down, and in case of any bad circumstances, it's extremely good when we have one plan.
Ongoing learning process, let's call it this way.
And that's why you trust the resolution authority, because they've done huge amounts of planning, simulation, testing.
Okay. Thank you very much. Thank you.
Thank you, Mrs. Földényi, for guiding us through the panel. We still have a couple minutes for questions from the audience, so please feel free.
Thank you. I have one question for Dominique. You mentioned that the SRB is supporting the FSB concerning public liquidity backstops. And in the panel you mentioned risks from NBFI. Would you continue or extend those public backstops for NBFIs, as, for instance, Bank of England supposed, or Duffy supposed in Jackson Hole?
So in your question, there are several dimensions. There's one about financial stability in itself. And that's true that the question raised recently by the Bank of England is around this. That's to say, okay, can we continue to consider that as a central bank, we can provide for liquidity only to our, let's say, well-known customers, bankers themselves, and not the other actors, even if these actors can need liquidity. So this is one area of discussion. I think this raises, obviously, other questions. If a central bank gives liquidity to a bank, it's also because this bank is well known by the central bank in terms of a quality of assets, in terms of compulsory reserves, in terms of a number of things which are disconnected from supervision. But you're obliged to pledge your assets, you're obliged to declare them, the central bank analyzes them, etc. So I don't know how the Bank of England will do this, but that's true that it comes back to my question. If we start to say that a non-banking financial institutions can benefit from a liquidity support by a central bank, it means that this NBFI will be obliged to enter into a form of regulation, because the central bank will not provide liquidity like this, definitely not. The other part of your question is for banks. They are well known, and we all know that there are systems, the discount window or the ELA, emergency liquidity assistance, which are based on this last element of the liquidity provision. That's to say, okay, we are beyond the normal operations, monetary operations, and the central banks, depending, are obliged to give more by accepting the failing bank to pledge what they have with a haircutting policy, etc., etc. And here, we are not sure. It's always a question of certainty, uncertainty, being sure, not being fully sure. We are not sure that in all circumstances the central bank will be able to deliver the liquidity needed on time. So what we've seen is that in a number of cases, also for stigma reasons, bankers were not preparing themselves enough and not testing their capacity of delivering liquidity by the capacity of pledging assets for delivering liquidity by the central banks. Because if they start to go to the discount window, immediately they create the conditions of mistrust in this bank, in the US or in Europe. So we are working also on that side. But what does this mean? Is that the ultimate piece of a jigsaw is the public liquidity backstop. If the bank itself is not anymore able to pledge anything, who could do this? And in the European legislation, there are already some elements which are in place, the so-called GGBBs, the government-guaranteed bonds, for instance, which can be pledged to a central bank. So there are already some elements, but we want to be sure that they are able to be used on time and accepted in the right sense by the central banks. And so we are working on other solutions. My take, and here I speak as a representative of the Single Resolution Fund board in charge of this fund, is that my take is that there is a shift in the potential use of a Single Resolution Fund, because we've built MREL. So normally speaking, we have sufficient amount of loss absorbing capacity. all in all. So that means that the 80 billion euros I've mentioned will be used much more for liquidity purposes than for solvency ones. So the first liquidity provider will be the Single Resolution Fund itself. Then the second one will be the ESM backstop. And then the third one could be potentially central banks with a public liquidity backstop or things like that. So we are, let's say, tying the issue depending on the size of the liquidity needs, and we are working on all these elements.
Is this on? Yes. I wanted to touch upon two topics that were actually addressed, but maybe very briefly. One for Thorsten, one for you, Dominique. So Thorsten, I was thinking in the case of if there is something we can learn from the crisis in the US last year, is that systemic risk can sometimes arise from corners in the financial system that you do not necessarily expect, right? These are non-globally systemic institutions by any mean, right? The case of of SVB, just to mention one example. And this is something that when I hear the European discussion, I don't work in Europe, but when I hear the European discussion, I see a lot of emphasis on trying to put these distinctions between this institution and these other institutions. But then in reality, we see that the crisis emerges from a corner where we were not expecting it. So I was just wondering if you could briefly comment on your view about this type of ways of defining resolution frameworks in the case of Europe by distinguishing between types of institutions. Obviously, you cannot include everyone, as Dominique was saying, to increase or to enlarge the list, but it will be interesting to know. And Dominique, very brief. So from the case of the Swiss experience last year, one interesting case that you were also briefly mentioning is the fact that in terms of liquidity backstops, the Swiss National Bank was stepping in a kind of unprecedented way, right? So, and they were basically giving up a lot of criteria that they normally use in their normal operation. For example, changes in the eligibility criteria of assets that they accept, changes in haircuts, changes in collateral, right? They were accepting assets that they will have probably never accepted in a different context, right? So I was wondering how, in your case, you see the importance of coordinating an institution like yours with the national central banks, because in a real case scenario, probably if you have a bank failing in Spain, you will need the Spanish colleagues, just to put them as an example, close to you in order to change their approaches, in order to try to go hand in hand with you in trying to resolve a failing bank. Thank you.
So on your question, so I actually want to give two answers here. The first one, on SVB, it shouldn't have been unexpected, I would say. I mean, I think there was supervisory failure because there was lots wrong in this bank, in their risk management. I think there was no CRO, I think. And the acting CRO was sitting, I think, in Hawaii, being on the beach. That's so much about remote working. I mean, I could talk about this too, I won't. But so there was something deeply wrong, which I think should have been picked up by the supervisor. And the fact that it wasn't subject to the same kind of scrutiny, both the regulatory requirement of Basel III and the supervisory scrutiny, as it should have been, I think that's why it was unexpected, but it shouldn't have been. Now, having said this, my second answer to your question is yes, fragility can come from unexpected sources, from new sources. I mean, that's just, I think, as I see it, and I said this morning, this is partly the task of financial stability departments. Because once, if I use this overused picture of the trees and the forest, the supervisors are responsible for the individual trees, but the financial stability are responsible for the forest. And what else is going on there, right? Maybe on the ground, on the top, somewhere, new plants popping up. So that's exactly their task, to see where new risks come from. Now, for the resolution, it also means that, again, as Dominique pointed out very nicely in his remarks, they have to be very agile. And they have to see that they are ready for different types of shock hitting a bank or several banks, and thereby then also adjusting their resolution tools accordingly. I mean, that's again what you mentioned, the optionality, I think, right? They have as many options as possible, given where the actual shock comes from.
Just to complement with one word, coming back to the EU regulation we have to implement everywhere here, like in the other EU countries, the key underlying assumption is indeed an idiosyncratic crisis. It's one tree, it's not the full forest. If there is a full forest burning all at once, it's a different story. Coming to your question, you touch upon one of the most difficult elements, which makes me thinking that, and here I'm coming back to the banking union, obviously, thinking that we need to reach the other bank. We are in the middle of a river, and we cannot come back, but we've not finished to cross the river. Why? Because we have a first pillar of supervision, so the decisions are taken in Frankfurt with the supervisory board, not anymore in Paris, Brussels, Amsterdam, Madrid, or Helsinki. We have a second pillar, which is a bit more complex, because we decide in Brussels, but indeed the implementation is for the national authorities, because we've not harmonized the comparison between resolution and liquidation. There are still national insolvency laws. But more than that, and I go to your question about liquidity, more than that, the euro system is made of, in reality, 20 central banks. In our system, when there is a liquidity assistance, it's given by a national central bank, not by the ECB. The ECB does not grant ELA. It's granted by national banks. And the point you raise is exactly the one which can be seen as a little bit worrying. When there is one country, like here, one government, one central bank, one resolution authority within the central bank, by the way, but okay, you can potentially manage a solution. This is what the Swiss did during the weekend. They were able to pass a law, to change the law. They went to Parliament and they adopted finally the famous law they should have adopted a long time ago. They adopted during the night between Saturday and Sunday, but they made it. You cannot imagine that in our case we will be able to ask 20 parliaments to change the law in one night. That's definitely not possible. So we need to consider that we need to find clarity ex ante. And again, I repeat, you can say, but you should be completely worried because, you know, you have no solution, while in Switzerland there is a solution, while in the US there is a solution in the Title II, so the big crisis. In that case, there is a potential agreement between the Federal Reserve, the Treasury, and the FDIC to unlock some liquidity with some public backstop at the end. There is a famous letter between the Central Bank of England and His Majesty's Treasury, so we don't know exactly all the elements, but there is an agreement, and that's enough to create the condition of this liquidity provision, and there is not such an agreement for the moment. So why am I not so worried? Because I think, as I said, that in reality we can tackle now the vast majority of the cases with the tools we have. That's true that for the tail risk, that's to say the biggest of the biggest banks, we should find, like the others, a solution, perhaps on the liquidity side at the end of the night. That's why I want to make progress during this work at the FSB level for public liquidity backstop and come back to the European table saying, well, much better to agree now in peaceful time than to wait for Saturday night. Sorry. Yeah. Okay.
So, sorry. So if you have a short question.
Sure,
yeah,
very
okay.
short.
Yeah,
Thank you very much for
finish
this
okay.
interesting discussion. When referring to the risk of digitalization, you refer to digital bank run. Do you think there is a role for a central bank digital currency in mitigating or in managing these risks?
Well, sorry, I start. We have looked at this, and we have not finished, by the way, because, you know, things are not settled yet. There are different ways of interpreting the digital euro. One way is to say it would be better to have a digital euro than to continue with the Chinese, US, and other proposals for digital money, digital currencies. Perhaps better to have a central bank currency instead of these private things we are using via the iPhones, etc., etc. So this is one way. But indeed, there could be a consequence. What we've seen, I will be short because Thorsten and Ruth will complement. What we have seen is that we should not, for the moment, overplay the consequences of bank runs due to digital tools, be they the digital currency issued by central banks or not. For central banks, there would be a threshold, a ceiling of 3,000 euros, something like that. So at the scale of a big bank, it's not a lot. And even if there is no ceiling, we are reaching a population which is young, well-equipped, etc., etc. What we have seen in March 23 instead, in terms of stickiness of the deposits, zero impact on the European banks. So the startups of Silicon Valley were withdrawing in 10 seconds $1 million from one bank to the other. At the same time, in Europe, nothing. So we should keep, let's say, analyzing the consequences. I think we have time to do that. There could be a source of additional instability, this digital currency, but not so much for the moment, I think. I don't know.
So I'm actually very critical of central bank digital currencies, and if you design it in a way that is really a replacement for a substitute for cash, then yes, there is the risk of systemic banking runs where the money flows out of the banking system into this digital cash. Now, the way the digital euro is constructed, that's not the way. It is effectively a payment system with the limit, as I understand, in your wallet of 3,000 euros, which, of course, you can argue, well, it enables bank runs, withdrawal of money even more rapidly. It makes also cross-border transfers much quicker. But then again, if this didn't come into place, there would be other means of withdrawing money. So I don't think it really exacerbates it. It has a lot of benefits, actually, this new payment system. And as somebody who has accounts across the euro area, I can certainly also see my personal benefit here. But I don't think it makes the situation worse than it is. And ultimately, maybe as the last point, I mean, we all see bank runs as something negative. Yes, it is something negative. You can also see it something as just a manifestation of market discipline. So the issue is just more, how do we react to bank runs? How quickly can we intervene? How quickly can we resolve a bank? Because behind most of bank runs is a solvency concern. There's really something fundamental wrong with bank. Yes, there are some outliers where it's not the case, but then again, there is the lender of last resort, there's the ELA and so on, that can ultimately step in.
Thank you very much. So we have to finish it. Thank you very much for your participation, for your time, and have a good day.